3, 2, 1. Hey everybody, it's me, the Einstein of Wall Street. We are here with Trade Like Einstein. I am Peter Tuchman, and we're here on the floor of the New York Stock Exchange in the balcony. History is made in this building every single day. Somebody with my long-term experience, I've been here for 137 years. It is my responsibility to help teach you how to navigate this market successfully. Boom! Today, I'm bringing you somebody so extraordinary, somebody who's had a big part of my life all the way along because he tells the story of Wall Street on a daily basis. He is a co-anchor at Squawk Box. He is an author. He's a co-writer of Billions, the show. I'm sure you've all seen that. And he's just an extraordinary human being on all top of that. So I want to welcome you.
Thank you.
Andrew Ross Sorkin.
An honor for me, my friend.
It's for me, too.
This
Amazing.
is so fun.
It is so fun. We actually ran into each other the other day. He was filming, so he's just recently come out with a book. You all have to check it out, okay? So he was here on the floor with Leslie Stahl, who you all know from 60 Minutes, doing the story about the book, right? And the book, actually, one of the things, it's probably one of the bigger parts of what I want to talk about today is because one of the things I talk about a lot is the fact that, first of all, I'm one of the few traders alive today who's actually lived through every crash except 1929. Some people believe I was here for that. I wasn't. I wasn't here when George Washington was inaugurated president. Disclaimer, that's not the truth. But I've been here for the crash of 87. I started here on March 28th, 1985. So I was here as a clerk for the crash of 87, the 2000 bubble, the financial crisis of 08, 09, the COVID bubble, and what I called, and I don't use the word crash lightly, the mini crash of this year's February, March, and April, which was basically a self-inflicted economic Armageddon caused by, the new sheriff in town. So the fact that you've written this book, and the one thing I will always talk about is that there's nothing in common about crashes, except the one thing that is common about all of them is that before they happened, we were at record highs. At each one, before the crashes. And so we were going up until we stopped, right? You can go back to February 12th of COVID. That was the beginning of the sell-off. You can go back to February 19th of this year. Record high. You can go back to the bubble of 98, 99, all those things, and 87 as well. I don't know about 1929, so you're going to have to tell me a lot about that, because that is not, and in a lot of my talks, I will talk about how each crash has different components that made them happen, and how everybody should know that. One was a predatory lending one. One was a healthcare scare, obviously. But tell me about the 29.
Okay, so 29 was really actually the only crash that I would argue was actually about stocks.
Really? Because none of them were. Really?
None of them really were, except this one in the following way.
Okay.
So back in 29, back in the 20s, it was the first time that ordinary Americans could actually really get access to all of this.
To the stock market.
To the stock market in a meaningful way.
Wow.
So prior to that, it was very tough. And not only was it tough
just kind of exclusivity.
The exclusivity, there weren't brokerage houses around.
So
it was
no access.
And what made it accessible was that the bank, specifically a bank called National City, which was just down here on Pine Street.
Okay.
National City becomes Citigroup.
Okay.
And a guy named Charles Mitchell. Right. He clocks what's going on in America, which is that all of a sudden General Motors is offering people credit. They're loaning out money so you can buy a car.
Right.
Sears Roebuck saying, you want to buy an appliance, we'll loan you money.
Right.
He says, we're going to loan you money so you can buy stock.
Wow.
And it's the whole idea of he wanted to democratize investing. We talk about democratizing finance. Okay. The distinction was, back then, he would offer you $10 for every dollar you were willing to put down. So you could walk in. First of all, as a result of this, the brokerage houses are then popping up around New York and major cities like Starbucks on corners. Literally.
Okay.
If there was a
had the same lending protocol.
So
gotcha.
And you could walk in a hotel. There'd be a brokerage.
Really?
The Plaza Hotel. The Oak Room Bar.
Yeah.
Okay, it was Prohibition in 1929.
Right.
That was in E.F. Hutton.
Wow.
People would walk in. They'd put down $1.
And get $10.
They'd get $10. They'd buy shares in.
Could they buy it right through that person?
Right there.
Easy access.
Right there. Easy access.
That's amazing.
And so everybody, for the first time, is now playing the markets in this sort of crazy way.
Yeah.
1928, the market was up 40+%. I think 42, 48%. From the beginning of 1928 to September 1929, the market was up 90%. So, and if you had were getting a $10 loan for every dollar.
Right.
This was like free money.
Free money.
And this had never really happened before.
Of course not.
And so what you had was this bizarre situation, which is everybody was levered. But not only were the banks levered, companies started lending to brokerages. By the way, they wanted to get in on, I mean, literally taking their balance sheet to get in on this whole crazy situation.
Yeah.
And the other piece.
How were they actually making money, though? If so, somebody gave them.
They would make a loan.
Right.
And they would.
Were they getting a percentage?
They were getting
of what they were making.
Yes.
Okay.
Yes.
So they became your partner as well as your
your
margin person.
Yes.
Okay.
Sort of. Bottom line, companies start to create these what are called investment trusts, which were the equivalent of sort of they'd stuff a company with an actual operating company with some leverage. Then they might even take their shares, use those shares to buy other companies. I mean, people were doing sort of wild things.
Right.
And in
the ingenuity, look, you see it happens today as well.
It was amazing.
I mean, if anything can be thought of, somebody thinks of it.
People were thinking of everything under the sun.
Oh my God, that's amazing.
And confidence effectively just broke. I mean, there really was a confidence break.
Really?
I would say it
was something that catalyzed that.
There was a guy named Roger Babson, who right after Labor Day in September, it was called the Babson break. It was really the first break. He had been a Cassandra for a long time. He'd been screaming from the rooftop saying this whole thing is cuckoo for Cocoa Puffs.
He did.
Oh yeah.
Okay.
And there was another guy who I bet you do know, named Carter Glass. Carter Glass, you remember Glass-Steagall becomes a bill that breaks up the banks.
Yes.
Carter Glass was the Elizabeth Warren of his time. He was a senator in Virginia.
Right.
And for years, he would rail about this thing called Mitchellism. Charlie Mitchell, the guy who was... Right. And he kept saying, this is all going to end spectacularly badly. And so you were seeing this sort of confluence of these different voices. The other thing the Fed was trying to do was they were desperate to try to end the speculation. Okay. So there was a big debate about raising interest rates, kind of like the way we have debates about that now.
Yes.
But they were a little scared of doing that because they were a new institution. Talk about independence in politics.
They had no history.
They had no history. They thought, you know what? If we raise interest rates the way, Volcker wasn't around. If they had raised interest rates, they thought the Fed would be removed. Congress would just end
get rid
this.
of them. Yeah, of course, right.
So, but they start sending out letters earlier in the year to banks saying, please don't lend to speculators, which was sort of an interesting thing. Some banks chose to keep lending. Other banks
was there any kind of
stopped.
Okay, when you walked in, literally for a while there, they were just lending it to anybody. So obviously the speculators came in.
Yes.
So there was no due diligence on their part at all.
No. And by the way, somebody said to me the other day, in your research, did you ever see any prospectuses for companies?
Right.
I said, a prospectus? You'd be lucky if there was a leaflet, because most of the trading was happening either in this room or what they call the curb market. The curb market was literally the curb, the physical curb of the street.
There's a photo here which you can see of how they were trading out on the street. Yeah.
And so, by the way, you know where you always see those pictures of people in October 1928, and the streets here are just lined with people?
Yeah.
The reason they were lined with people was because the board, the numbers on the board, were so blatantly out of whack in terms of the time. Right. They were oftentimes 4, 5, 6 hours delayed.
Wow.
So it was like, it was like being at a baseball game, betting in the 8th inning, or betting in the 3rd inning or the 8th inning when you're looking at the score in the third inning.
Right.
I mean, it was this sort of.
Well, there's a photo around of that I've seen. I actually have it in my house of a kiosk. It was like a bar with a bunch of people standing. There were these rotating phones, and they all looked like traders of some kind, and then they had spittoons, and they were all sitting there in sort of shabby suits because they didn't look like they were people of wealth. They just looked like they were low budget characters in these they all dressed the same, and they were obviously making money. So you would see them. There was one ticker tape, and they were all watching
the tape,
and then running to the phone and making it.
And a lot of those guys were calling to the different brokerage houses.
Right.
But the reason why those streets were full of people is people had started to decide they had to come down here to try to figure out what happened to their money.
Wow.
Because even if you were uptown, the brokerages were.
It's 1920.
And so people were, and you could hear the roar in this place was so loud that people outside could hear what was going on. I mean, it was kind of insane. Now, there's one other thing that was going on that could not have happened today, or I pray doesn't happen today. You know the story about RCA? You know about these pools, these investment pools?
No.
Okay, so back then, this is pre-SEC, pre-insider trading. What I'm about to say was legal then.
Okay.
There was a lot of manipulation going on.
Okay.
And one of the things...
By market makers or by...
Okay, so I'll give you the big example is RCA.
Right.
Was the NVIDIA of its time. It was like the meme stock. Everybody was excited about radio technology. They had the patent on TV.
Right.
This was going to change the world. Everybody wants to buy RCA. Yeah. Okay. A guy named Mike Meehan, who's the specialist for RCA. He is the guy. He calls up.
Meehan?
Yes.
So they went on. They were here until recently.
Yes.
Terry Meehan was a market maker up until 5 years ago.
So
same family.
So Mike Meehan would call around to a bunch of super wealthy investors in New York, most of them up on Fifth Avenue.
Right.
And he'd say, I'm going to put together a pool. You give me the money, and we are going to run a pool on RCA. And for the next 2 weeks, we're going to press the stock, and then we'll pull the rug. And literally,
pump and dump.
It was a total pump and dump where he would have the equivalent of almost actors, different trade. He had people on the floor saying, I'm in for 100, I'm in for 1, but all orchestrated. I mean, like literally like actors. And they would do this, and they would leak articles to the journalists.
Right.
The journalists, by the way, were all on the payroll.
Right.
All in the payroll. They call up the journalists. They say, by the way, you need to write an article that such and such is going to go up tomorrow. Right. And the journalists would do this.
Oh my God, that's spectacular.
And it was just completely wild. And so that's happening. And then they'd pull the rug. Now, some people, the public, kind of knew what was going on. Meaning, sometimes they'd even be these articles about how there was a pool in X stock right now. Wow. And so the question was, could you jump on the train and jump off the train fast enough to basically benefit from the pool beforehand? And so then that was the other kind of thing people were playing.
Betting on the bettors. I mean,
they were betting on the bettors. Who was going to get in? When were they going to get out? How long was this going to go on for? Could it go for 2 weeks? Could it go for 3 weeks? Were enough other people going to press it up? So there was, I guess the point is there was a whole sort of confluence of things that then, come October, really sort of...
Was there up until that crash date? The crash happened on one day?
3 days.
3 days.
Happened on a Thursday, happened on a Monday.
Okay.
Friday was, The Friday things came back a little.
Okay.
Or maybe, yes, Friday things came back. People, they'd settled down.
Okay.
Thursday
was significant.
Thursday was big.
Like 20, 30, 40%.
I think I don't think it was that high.
Okay.
Then Friday was things seemed like things were getting better, calmed down. The weekend, everybody was still, by the way, half the time they were tallying the trades. People were sleeping on the floor because they needed to get the trade. Nobody knew where things were.
Right, of course.
Then Monday's down another 13%.
Okay.
And then that next Tuesday, you have another big drop, 20. So you had, I think, from peak to trough, you were sort of at a 40-50% situation. Right. Having said that, and people think that they all think that October, it was a 1 day. It happened over a period of time, really almost weeks. Strangely enough, the market actually came back, not to zero by the end of the year, but the market was only down 17%.
By year end.
By the end of 29. Wow. So there was this view that somehow things were going to be okay.
All right.
The problem was, because all those people were on margin.
Right.
It wasn't just that their stocks had fallen.
Right.
It was that
they owed money.
It was they all owed money. So Groucho Marx, the famous Groucho Marx, this guy who's one of the most conservative, he was an actor, he wasn't even famous yet.
Right.
He's out in Long Island. He used to basically live at the brokerage house all day long. He'd read the tape. He was buying and selling like a crazy person. He gets a call in October from his broker who had told him, if you buy RCA, you're going to be fine, my man.
Right.
And he says, you better get down here because
you owe millions.
And he had to mortgage his home. Wow. And so that was happening over and over again. And then that started to seep into the real economy.
Right.
In 30, 31, 32. The story of 1929 really goes all the way through 33, and then obviously you could go even farther than that. But it's really a sort of
this was almost a decade of pain.
It's like a slow roll.
Wow.
But also there were a whole bunch of decisions that weren't great. So the market was the sort of first confidence killer.
Right.
Then you had Hoover, whose Treasury Secretary was a guy named Andrew Mellon, and Andrew Mellon used to say, "Screw him." He was a true capitalist. His view was, you lose, we don't bail you out, we don't help you, we do nothing.
Okay.
So So
did he start Mellon Bank? Maybe.
Correct.
He did.
Yes.
Of course.
Mellon family.
Of course.
So
some of the richest families in America.
Pittsburgh. He was based in Pittsburgh.
Right.
So he was whispering in Hoover's ear. They raised taxes. Not the best time to do that. Right. It was a real austerity period where people were trying to pull back rather than what we did in 2008, which was flood the system with money. It was politically unpopular to flood the system with money back then. But that was the lesson of 29, which is instead of pulling back, you have to flood the system.
Yeah.
So you had the taxes go up.
Right.
You had a real push to try to actually raise people's wages. So Hoover was trying to jawbone corporate CEOs, sort of the way Trump does today, he was trying to get them to raise the wages.
Right.
Well, that was helpful, sort of, but not really, because then they started firing all these people.
Right.
Okay.
Just like today.
Then the president, Hoover, decides he's going to put tariffs on the world. So it's called the Smoot-Hawley tariffs, 1930.
Okay. Yeah.
He had run on tariffs, so he desperately needed farmers to vote for him.
Now, these were tariffs on foreign, or these were tariffs
foreign?
on
No,
they were foreign
on
tariffs.
all the foreign tariffs and all that, because he said to all the farmers, he was desperate for their vote.
Right.
In 28, as he was campaigning around the country, he says, "I'm going to tariff the hell out of all these countries so that you can have a stronger business."
Right.
They love him. He says he needs to go through with his pledge. Economists around the country are going to Washington saying, "Hoover, I beg you not to do this. Please don't. This is a terrible idea." They're writing full-page ads, signing them the same way they did this past year. And he does it, puts it through with Congress's help.
Right.
And what happens? Global trade falls by 60% in 12 months.
Wow.
So it was sort of a combination of things.
Yeah.
By 32, we had unemployment in this country of 25%.
Now, were there bread I have?
There were the bread lines. Yes.
Bread lines like after that day.
Yes. Not after the day.
Instantly?
No, 2 years later. So. Unlike 2008, where you had Occupy Wall Street and a whole bunch of things happen almost immediately, that was not the case. This took a couple of years, but to the point where there were tented camps all over the country called Hoovervilles, including, by the way, in Central Park.
People had lost all their money.
They'd lost all their money. They'd lost their home. Some of them were camping out in the middle of Central Park, across the street practically from where Charles Mitchell. So Charles Mitchell, the guy I told you about.
Yeah.
You ever been on Fifth Avenue between 75th and 74th? There's a French consulate.
Yeah.
It's beautiful.
Yeah, it's beautiful. Yeah.
That was his home.
Wow. Okay.
And 4 blocks away.
The rich stayed rich, right? Those guys never took a fall, or did some of them?
A
Were
lot
there stories of big guys?
A lot of them took a fall because Charlie gets arrested in 1933.
Okay. For?
I don't want to give away the story, but
'cause it's in the book.
It's in the book. But Charlie puts the whole bank on his back. He makes a secret trade to basically buy a lot of stock in his own bank because the bank had made an accident. There was an accident that happens in October of 1929, which is that the trades were coming so fast. He had told his traders to buy up their own stock as it was falling. He was trying to keep the price of his own stock flat.
Right.
They bought too much.
Yeah, right.
And they couldn't afford to buy it.
Right.
And if anybody knew that they had to get rid of it, the whole bank would have been a run on the bank.
Right.
So he goes actually literally over here to JP Morgan.
Right.
Gets them to give him a personal loan, and he buys $12 million, which is extraordinary.
Which is a hell of a lot of money.
$12 million.
Easily $1 billion or more.
$12 million of his own company stock.
Right.
He now has a huge loss. So he says
on the books.
On the books.
Right.
And he had also made some money that year, oddly enough, in cash.
Right. Okay.
So he decides that he wants to reduce his tax bill because he thinks he has done a mitzvah for his bank.
Right.
So he goes to his wife and he says, "I'm going to make you a deal. I'm going to sell you my shares.
Okay.
So that you'll own the shares. We'll show it as a loss.
Right. And then we can deduct it.
And then we can deduct it afterwards.
In our taxes.
It was known as a wash sale, which today is illegal.
Yeah. Very
illegal.
Yes.
Well, so he does that, and they knock on his door up at the house.
Right.
And
but was there an SEC yet, or it was just
no SEC?
The regulators?
There's no
The
SEC.
police.
This is the police. At this point, Roosevelt had just become the president.
Right.
And Roosevelt says, "Go do this."
Wow.
So Roosevelt says, "Yeah, that's the other thing." Roosevelt's got it. He got his people. He says, "You're going to go after this person. You go after this person."
Wow.
So they go after Charlie. I won't tell you what happens to Charlie because it's fascinating.
Wow.
What happens to Charlie is actually completely different than what people would think might happen to Charlie.
Right.
It gets crazier than that.
Wow.
But so all of this is happening during this wild period.
Nobody knows that story. I mean, that's why this is going to be great. Right?
Hopefully.
Well, I would think so, because you know what? They're right now. So that's what I'm dealing with right now. I'm dealing with the fact that you just talked about the democratization of the trading community. Okay, one of the stories, I do a lot of public speaking all over the world to students, high school, college, and whatever. And one of the things I talk about is that the radical change that happened during COVID, which is the democratization of the trading. With the advent of Webull and Robinhood, suddenly everybody, you need to be an accredited investor before then to trade the market. Your father or grandfather opening an account at Merrill Lynch had to prove that if he lost 100% of this investment, it would have to have no effect on his standard of living for 5 years. That was the shtick back then. Okay, COVID comes along, Webull, Robinhood, all these free trading apps come along, and suddenly there are 50 million new people in the market. Anybody with an iPhone and $100 could trade the market. Right? There was no education, no educational component in their access model. It was just like, we're giving you free reign. They didn't let people margin, although they did to a couple of people, and that kid actually committed suicide. There was one kid in the beginning of Robinhood who got leveraged, and it was supposedly a mistake, and he ended up committing suicide.
By the way, back in 1929,
lots of suicides.
A lot of people jumping out of windows. There's a couple of main characters in the book who end up shooting themselves in the head, literally.
Well, we saw, the one thing I'll say, Jordan Belfort said, it's, what's his line? It's the word, it's what about being rich and being poor. I've been rich and I've been poor, and being rich is a hell of a lot better. Having been rich, having lost all your money is definitely suicide worthy.
Listen, one other thing, by the way, because people do think that 1929 was like a massive number of suicides. Technically, from a data perspective, less suicides in 29 than the year before.
Really?
Yeah.
Wow, that's curious.
It is curious. But they were all in the news.
Right.
Of course. Yeah.
So going back to that, so 50 million new traders, as per TD Ameritrade data, have joined the marketplace, okay? And so for me, I sort of came in to embrace this group of all these people. That's when it was almost like a perfect storm. Access to the market through Webull and Reddit, through Webull and Robinhood, okay? We're all sheltered in place because of COVID. Everybody had a couple of stimulus checks in their pocket. Everyone is at home. All eyes are on the stock market. Reddit comes along. This whole meme phenomenon happens. This all happens at the same time.
Remember.
And so this was like a perfect storm of what fueled, most of those people. And I was tracking it day after day. I was in GameStop when it stopped trading 29 times that day. So I was actually analyzing most of the people. 80% of day traders are losers anyway, but a majority of these people got smashed up quite badly. The few that made a bunch of money posted themselves, pictures on the back of a Bugatti with stacks of 10,000s. But a majority of people who came into the market at that time blew their trading accounts up radically. And they didn't come back for a number of years. But that was this was the 2025 or 2020 version of the democratization of the stock market. Suddenly, 50 million new people came into the market.
Okay, so do we think this is a good thing or a bad thing? I think it's a great thing.
I think it's a great thing.
But the question is, how do we do it in a way so they don't get hurt?
Okay, so that's when I took on. So I started on Wall Street in '85 with a guy named David Green. David Green had 4 brothers. They started here as squads. They all became market makers. The largest family market maker group. He got a buyout when Spear, Lees, and Goldman made the worst deal in Wall Street history, when they bought it for $4 billion, and they sold it for $200 million a few years later. When Goldman bought Spear, Lees, the market making firm. Okay, so he retired at 38, and he went on to try and trade on his own. He blew up as well. So we've known each other for 40 years. When this thing happened with COVID, we decided that none of these free trading apps had any education. He was a technical analyst. So we built a course, an academy, teaching people technical analysis and charting, how to make money trading the market. That it isn't a get-rich-quick scheme. FOMO, hype, hope, those are not trading strategies. If you want to do this and do it successfully, you've got to learn the rules of the game. Discipline, consistency, that's how you do it. And so we've been doing that. We have tens of thousands of students all over the world, and that's what we've been doing. So I kind of took it about, I figured the only way for this not to end badly is to educate these people, not just give them access to I always use this analogy. It's like, if suddenly it's like Studio 54, like I was this doorman at Studio 54 in 1980, right? So suddenly people who are not let into this party called Wall Street For all these years, suddenly the red ropes were gone, and you all had a free reign to do this, but no one told you that if you drank 12 shots of tequila, you would get drunk and sick and do stupid stuff.
Okay, so I got a different one for you.
Okay,
so when you saw me down on the floor with Leslie Stahl, one of the questions that she was asking me is, one of the things that's happening, talking about democratizing finances, is a move afoot to let people get access to venture capital, private equity, private credit. This is all going to be available now, potentially in your 401k plan.
Really?
No, this is the next.
So that's the next. That's similar to the lending that went on back then.
This is like the next step.
Right.
And there's part of me that thinks that it's actually a great thing. Again, you want to democratize finance and all of that. And there's part of me that worries about it.
Because you know what happened that last time that happened.
Because it's complicated. And the truth is, the companies that trade on the floor here with you, you get the disclosures. You get to see all of the material.
Yeah.
Private companies, when you look at those NAVs, the NAV, maybe we need to explain that, what an NAV is, but an NAV is basically a valuation made by a fund manager on the assets.
Right.
Sometimes they say it's mark to make believe, right? And so what?
Not mark to market.
Not mark to market, mark to make believe. And so then what happens? And whether it's not that the big guys, hopefully the big guys will do the right thing, but when these new products emerge, it's always like the charlatans that show up. I mean, I thought the SPAC stuff was actually fascinating. I thought SPACs could be a great thing.
Yeah, but they overdid it.
They overdid it.
Right. The SPAC was a good thing until it got to the point where there were not enough companies to get under the umbrella.
Right.
And they, the idea that they were stopped at $10, and that whole thing made sense for a little while, because what they were doing, once again, is making things accessible that weren't accessible before.
Right.
But that blew up in their face too, because they overdid it.
Right.
Right. Then they had to stop doing the SPAC thing. Then they had to de-SPAC and do all that kind of thing. I'll tell you an interesting story though. If you know the history of the WeWork,
I remember WeWork. Yeah.
So in 2017, 18, 19. IPOs were like wildfire.
Yep.
We were doing 10 of them a day, and they were all opening at a beautiful premium and going up, and it was beautiful. Until the WeWork thing, okay? Everybody put that this was the great story about this guy who came up with a great business plan, right? And they were, people, SoftBank were putting in $50 billion. All this wild, everyone's throwing money at it because it made sense from a real estate point of view, a business point of view. Until the night. Now, if you were to ask anyone before that debacle, which was the IPO that never happened, do you think that we know the finances of a company the day before, you go public? It turns out that when a company is going public, the world or the investment community actually doesn't know the real nooks and crannies of the value of the company until the night before. The night before that IPO was supposed to happen, when they opened up their books to everybody, when they were allocating the stock, it found out that they had spent that there was no money there, that all the money had been spent on cocaine and hookers, right? And then the deal fell through, literally in the witching hour.
Yep.
And what was the worst part of that, the heck with Mr. Weinstein, Weinberg, whatever, Iceberg, Goldberg, it affected the IPO market for years to come, because IPOs are based on confidence, right? And that literally destroyed the IPO. We're just coming back from that debacle, right? Which is
so interesting, and that's what's so interesting about the sort of psychological scarring. Talking about confidence. So my grandfather was 11 years old in 1929.
Okay.
His brother was a messenger boy down here,
a squad,
on the floor, and he brought my grandfather down there with him. He skipped school, and he watched somebody jump out of a window. No joke.
Wow.
He lived till he was 91 years old, but he never bought a share of stock his whole life because of that. So when you talk about confidence, there's sort of a generational scarring. You talk about WeWork taking that long and the impact. It's an he would buy bonds. He would tell you to put your cash under your mattress, and that's the way he thought. There was a whole generation.
What did he do for his work?
He had a whole bunch of jobs. He worked in the photography industry, but he had a great life, and it worked out for him. It was not a problem. But a lot of people got very wealthy. That's the funny part about all this. We can talk about crashes all day long, but the truth is, you almost have to be a professional optimist if you're here, because over time, even though you can worry about a crash, if you have enough running room, the markets go up.
So then let's talk about the whole premise of the book.
Yep.
Right? Your belief is, and I haven't read the book yet, is that you believe that what we're setting up here with the way the market is going and the economy is going and all that, that we could be mimicking some of the similarities of what happened in 1929.
I think there's a bunch of things going on that are sort of 1920s-ish.
Okay.
My hope is that between the SEC, between the lessons we learned in terms of what the Fed should do after these types of things, that if we have some kind of crash, it feels a lot more like 1999, which, by the way, was bad. I don't want to tell you it wasn't bad, but it was different.
Yes,
and I think that's the big thing. The one thing that I'm not so sure about this time, so you had said before that each crisis has a sort of some different parameters
and comparisons.
The one thing that I actually think is always the similarity is too much debt, too much credit, leverage in the system. That's when things get really out of hand, because then impacts the banks, impacts lending. It really hits the economy in this sort of perpetual way. 2008, it was subprime loans. 29, it was margin loans, and it really then sucks the confidence out of the whole system.
Well, it's okay, but then think of how much we learned from 08 until COVID.
Correct.
Because in 08 we had a crisis. Obviously it was a different kind of crisis, and they threw $800 billion at it. Federal Reserve
and it worked.
And it worked, but it took 8 years to get back to even.
Right.
They threw it into the market over 18 months, and it took 8 years to get back to even. COVID was a way bigger, grander. It was a health crisis. It was global, right? And they threw $3 trillion into the market over 3 months. We were back to even by August 19th of the same year, and we were up 20% for 2020, up 21% for 21. So I think we learned a lot of lessons. How to print money, how to make it work, and how to adjust.
So I'm hoping that we can do that. The one thing that I don't know about this time is in 2008 and before that, for the most part, we knew where the debt and the credit really was because we got the banks. Today, the leverage is in a different place. And it might be better that it's in a different place. It's in these private credit vehicles, right? So Apollo, KKR, they all have a Blue Owl. They all have these funds, which they're the ones lending corporations money today. That's where the lends, more than the banks.
Wow.
That's where the loans are.
So they're taking some of their assets under management.
What they do is they go around to sovereign wealth funds and pension funds and say, hey, you give us a couple $2 billion. We're not going to give you the money back for 10 years.
We're going to invest it.
We're going to go loan it. We're going to loan it out to some company that wants the money. We'll loan it out, and you'll get an interest rate on that. What we don't know, because they're all private institutions.
It's not transparent.
It's not as transparent, so we don't know enough. We also don't know how connected those funds are technically to the banks. All the banks have liquidity lines to the funds. So we're not really sure anymore, I think, to the level that I'd love to know where we are. Do I think we're going off the cliff tomorrow? I pray we're not going off the cliff tomorrow. And I don't think we are.
What's his name? David Solomon of Goldman Sachs the other day said that he believes, what was it, within 1 or 2
years, we'll have an equity drawdown.
We're going to have an equity drawdown. Didn't know how big, didn't know when it was, but look, that's not that grand a statement to make. I mean, let's look at where we are today. So this market has been flatlining off the top for months. There's been no volatility. February, March, and April, we sold off in 11 weeks, down 20.8%. The only silver lining was if we could sell off that fast and furiously, we could go back the same way. We were back to even in 4 weeks when Mr. Trump told everyone to buy the market, that the pain was over. The sell-off was very self-inflicted by his ability to disseminate information the way he did. If he had come out to us and all said, you know what, tariffs are my thing, it's going to be a little pain for a little while, trust me, it's all going to be fine, we wouldn't have seen that sell-off. But the way he disseminated the info at 3 o'clock in the morning with a tweet saying 185% for China and this for that and then pulling it back, and then even Ken Griffin, head of Citadel, said
he wasn't happy about it.
He was a huge fan of Trump. He gave him $250 million of his own money. He said that this pattern is eroding the confidence of America and of our markets, and that's the downside of this. And that's what we saw was the problem with the market. We got back to even within 4 weeks, and then we've obviously been up since then. But we flatlined for a while. No one understood how, through all of that's going on, a couple of global wars, the whole interest rate thing, the tariff thing, all these, all this uncertainty around tariffs, right? We didn't know the deals were being made, backdoor. Besson said deal. Lutnick said done. All that stuff. We weren't getting anything.
Right.
And suddenly now all these deals have been done in the back door. That's, I guess, the way Mr. Trump does it. But we ended up, suddenly, I did report after report. What is going to be thrown at this market that's going to finally break it?
Right.
And nobody could come up with a real answer because it was just irrational enthusiasm. On Friday, so I have a photographic memory.
Yeah.
On the first time Trump was president,
right,
he was at Davos. The first time he was at Davos, it was 11 o'clock on a Tuesday.
I was there.
It was the first time he said China and tariffs. The market sold off 1,400 points within 14 minutes. By the day's end, we were up 1,400. We actually went from bear market to bull market. We had a 2,800 point reversal intraday that day. Then we knew that everything for some reason, it has that amazing effect, mentioning tariffs and China, because they are our biggest trading partner. They are they're two major egos, major world leaders. Whatever it is, why that's so different. But Friday, out of nowhere, they started playing bad in the playground together, and the markets fell off the cliff. For 2.5%, it's not the end of the world.
Right.
I thought the way the market traded, I also analyzed Fridays. And
so what did you think?
Well, historically, when we close at a low on a Friday before a weekend, we usually actually close at the low of the day. We usually gap down on Monday and continue to sell off. This time, for a number of reasons, because the narrative got softer over the weekend. They sort of made friends with each other. I think all the focus was on the Middle East hostage release. And all the pundits all weekend long weren't talking about that chatter about that we sort of disengaged the Friday sell-off and came back. I mean, we're now, we're back up half of what we gave back Friday. So, I mean, there are obviously two ways for the story to end when you have a massive sell-off. This is the better one.
Right.
But there are also a number of reasons why we are up today and not down. Many of them being there's a lot of underinvestment in the market by the big players. So if you analyze who was selling in February, March, and April, it wasn't the retailers. It was the big fund managers.
And you think they're coming back in?
And they're coming back in because they missed the boat. They missed that 4-week rally.
Right.
And they had to play catch up. And so if you've noticed, any pullback that we've seen has been so shallow because they cannot end their quarter. We had a $4.5 million buy program on the night that the third quarter closed. That's crazy. In a record closing quarter, for people to still be buying stock at that valuation, their hope is, their fulfilled prophecy is that today's high is going to be tomorrow's low.
Right.
And that's why they kept buying. So I think this is part of it. This was a great opportunity because they're being judged on their P&L. Right. And they've not been able to buy any kind of size till Friday, right? Or till today. And that's what they're doing, I think.
That's so interesting. Okay, let me throw one more at you.
Go for it.
AI bubble or boom?
Boom. All day, all night. So I did not know anything about AI. I like to surround myself with smarter people than me. I connected with Dan Ives, who is the father of AI.
Yes.
He explained to me the whole idea. I thought it was because I speak to a lot of younger people, and they kept imparting on me all the fears they have that they're never going to have jobs again because of AI. It's going to outsource humans in every respect, blah, blah, blah. And he said, not the case at all. First of all, that's not going to happen. It's going to better our lives in a big way. He then said that the CapEx spending by these companies is into the trillions. He often says on my show, he goes, we are in the second inning of a 9-inning game that's going extra innings. Okay, we're at 8 p.m. in a party that's going till 4 in the morning. We are still in the beginning stages of this. The CEO of SoftBank last week said that NVIDIA at $180. So February 23, NVIDIA was $103. February 2024, NVIDIA was $900. In June of 24, it was $1,200 after the June earnings. It split 10 for 1, and we're now at 180 post-split.
Wow.
And the SoftBank CEO feels that it's way undervalued at this level because of the demand for data centers and chips. That is so, I mean, look, who made a deal with AI today?
Broadcom.
Exactly.
Yeah.
So what you're seeing is not only are the Googles, the Metas, and the Oracles Why did Oracle go up that $100 that day? Not because the earnings were so good,
because they're spending
they invested on AI.
Future.
So that's a huge commitment, right? They're starting to build these data centers, which are 5 years out. All of that is happening. There's so much money going. So, and now, the only way these people can protect their fulfillment of the future is by partnering up with these other companies. Okay. That's why you're seeing.
So I'm going to throw in, by the way. So I'm as optimistic and as excited as you are. Yeah. But I'm also.
It's a revolution.
But you know, I'm also a journalist. I'm a professional skeptic.
Completely.
So the thing that I worry about, the concern I have, is that OpenAI, which is committing to buy all of these chips from all of these different players, technically doesn't make money yet.
Right.
Okay.
They don't.
They don't. And so the question is, when they actually have to write the checks for all of this stuff, whether they're going to be able to write the checks.
Is he rich enough to cover all that money?
And what you're seeing happen, a lot of this, talk about financing, it's a sort of unusual financing.
Right.
So you have this, what they call
creative financing.
Round trip financing. So NVIDIA very smartly has bought into OpenAI.
Yep.
They're going to give them $100 billion. Right. They're going to take the $100 billion and give it back to NVIDIA and say, buy my chips.
Yeah, right, exactly.
Right? Yep. There's even a more clever deal that OpenAI does with AMD. So AMD is out of the game.
Right.
OpenAI says, we'll make a deal with you. We'll come in to buy your chips. We'll get you back in the game.
Right.
You're going to give us warrants on your stock.
Right.
They know that if they announce this, the warrants are going to go up.
Yep.
Okay, well, now they have the cash.
Right.
To fulfill.
Yeah, to that prophecy.
Right? So there's a lot of things going on, some of which is a little bit.
It's reminding me of what you see, you know, when things get leveraged and things get a little bit, you know, it's amazing with AI.
Right.
We can analyze really complicated stuff.
Yeah.
Is it almost too complicated for even AI to figure out? Maybe.
We'll see.
I mean, those kind of leverage.
Right.
So these are great stories.
Right. It's
right?
fascinating.
And you know, it's amazing that. So I just had sort of read a blurb, so that you're not a doomsayer.
Yeah, no, I'm not.
You're cautious.
I'm super excited about. Look, I am so excited about the future.
Yeah.
I am so excited about the future. My only hope is that we don't miss the lessons of what happened. Yeah. That we don't take too many of the guardrails off.
Yeah.
But we look. Speculation. People think speculation is a dirty word. Speculation is the twin of innovation. Yeah, you need some semblance of speculation. Yeah. No, when the original investors put money behind Elon Musk and people probably thought what he was doing with Tesla was insane, they were speculating. Yeah. But you needed that.
Yes.
You just don't want it to go out of control.
Yeah, correct. And so, look, that's so exciting. I'm so excited for the book.
Thank you.
I think it's going to be spectacular, and we're going to pump it up like crazy.
Okay.
So let's step away from that. My pleasure.
I appreciate it.
Let's step away from that. Billions. Let's talk about billions for a second.
Please.
So, I mean, what was your... So, that, look, obviously for me, you know, so I'll tell you a couple of fun stories. So I started in '85. I worked for Cowan and Company.
Yeah.
The booth that we were in, right under the podium, was Dean Witter, Samala, which was the company of Ivan Boesky, and Cowan and Company.
Wow.
I was a clerk for Cowan and Company when Ivan Boesky was having his premonitions in the middle of the night about all the takeovers, right? He said he was hearing voices. The voices were of Dennis Levine, I guess, from Goldman, who was telling him about the takeovers. He was buying, so we would come in the morning, we were doing our business, and their brokers were just, in the old days when you were given an order, buy 50,000, buy 100,000 shares, you would say you bought 20, you leave 80.
Right.
When Samala bought stock, they would just say you bought 100. You didn't. You bought 100. That makes 200. They were just buying unlimited hundreds of millions of shares of stock because they knew in 3 or 4 days that they were going to announce the thing. I was offered a job clerking for them. Right. The day before, I was making $25,700 as a clerk for Cowan. They offered me something like 80 grand to be a clerk for them because I was good at what I did. I'd come down. I was smart. I thrived on chaos. I was really, I was a crazy, 27-year-old Wall Street guy. They offered me that money. I said, finally, somebody sees my value. They can see how great I am. So I went to my father. My father was a well-known doctor, but he had no relationship to money, Holocaust survivor, but took care of some of the most famous people in the world. I'll tell you a fun story about him. Anyway, he immediately said, beware of money. He said, maybe you're that great, but just that doesn't make sense to me. Why don't you sit on it? And he said, Saturday morning, it was obviously before the internet. Saturday morning, he called me and said, turn on the TV. And Ivan Boesky indicted for insider trading And so obviously it was a good move that I never left there to do that. But so that was sort of the precursor to the first Wall Street.
Yes.
Movie. Right, and then so obviously Billions is the story of Stevie Cohen. I mean, it
really wasn't. I mean, I think a lot of people thought that, but
we think that.
No, I think I like to think that Bobby was a singular character. Honestly, I think we looked at lots of different people in the universe just to try to. But it wasn't like there was one person. I think there were aspects of probably a lot of people. And I think over time, the truth is that the folks in the writers' room really created as almost a singular character.
Was there one person? Didn't Stevie Cohen benefit a lot off of what happened during 9/11, or that was a mixture of
not Steve Cohen? No.
There was somebody who did do a big bet against the airlines.
There were people who thought that happened.
Right.
I don't know if that actually happened.
Okay.
In truth.
Right. Okay. Well, look, it made sense.
Yeah.
Right. And it painted the picture of the bad guy.
Right.
Right. Which was kind of amazing.
Well, no, people always thought about, they thought about Cantor Fitzgerald, which was obviously they were in the World Trade Center, and Sandler O'Neill was in the World Trade. So everyone always had, but that was sort of the fun of it, I think.
Yeah.
That people
there was that guy who I can't remember his name at Bear Stearns.
Jimmy Kane?
No, he ended up killing himself.
Oh goodness, he ended up killing himself.
He was Bear Stearns Hunter. God, what was his name?
I don't know.
He was a major Wall Street guy.
Okay.
I'll find out when we go downstairs. But also, there were obviously people.
Yeah.
So Stevie Cohen, I used to be a $2 broker for Stevie Cohen before he became Stevie Cohen. Yes, and I probably may have made the biggest mistake ever.
What was that?
So I was doing $2 business for him. So that was like I was an independent broker. And so you had house brokers, and then you had $2 brokers. $2 brokers were those who did business for all the different booths, right? And you got paid $2 for every 100 shares you traded. So this young lady, Debbie, had the account with Stevie Cohen. He was just a guy up on a desk, right? He was nobody, no one that anyone knew yet.
Right.
And he was always right. And you had to make sure he knew he was always right. So he sent me into Philip Morris at the time with $1 million to buy or something. And I was really good at what I was doing, and I gave the order to this guy, Bobby Riley, who had everyone else's orders. He protected the order really well. He ended up doing great, but I didn't do exactly what Stevie Cohen wanted me to do, even though the result was way better than it would have been if. But he didn't care about that. So he called me up on the desk.
Yeah.
He sat the three of us down on a couch, and he goes, "I didn't ask you to do what you thought is right. I asked you to do what I told you to do." And I said, "But we did way better for you. We saved you." He goes, "That's not the whole point." He goes, "You do what I tell you to do or you're out of here." And I said, "Oh, I can't really do that." So he told me to go fuck myself, and I never did business with him again. And then, of course, he went on to become who he is. Right.
There
so
maybe
can you
get seats at a Mets game now, or what?
I would have now. I wouldn't change a thing on the docket for me. It's been a great career on Wall Street. But there are obviously people, So that I mean, what a great show, Yeah,
we had a lot of fun with it.
Yeah, and it really covered so many. It really, in a fun way, covered way better than The Wolf of Wall Street. Jordan Belfort, I don't know if you know the story
of course.
But of his relationship to the floor of the exchange. So he came down to the floor to recruit 8 brokers, right? Offered them all $1 million to give him insider information. So if I get 1 million shares to buy an IBM, back in those days, if you were certain brokers were really good and they stood in one stock.
Right.
So he went out to find the people who stood in one stock, and he'd say to them, that you buy the first, if you had $1 million to buy in XYZ, you buy the first 5,000, 10,000 for me, and then you sell the 10,000, the last 10,000 for me. It's just called front running. It's classic illegal trading, and they all did it. There were about 8 brokers, and they were well-known brokers who took him up on the deal. He came to me. I said no. I'd remembered what my father said: beware of money, and they were all taken out of here in handcuffs, and they all spent time in jail.
It's an amazing story.
And, people don't know that story. They don't know the fact that, he still hasn't paid back 80% of the money he took.
Oh, I didn't know that.
Yeah, and he's, even the lady who he took $300,000, her last $300,000, the day he already knew he was indicted, didn't pay her back. So everyone's entitled for a second chance. I don't give him a. Well,
I loved The Wolf of Wall Street, and it was a great film.
Oh, it was a great film,
yes.
But it was not as realistic as like when you tell the story of Billions.
Well, thank you. But
that was real Wall Street.
Credit goes to 2 showrunners who were my co-creators, Brian Koppelman and Dave Levine. They should get the shout out.
Okay, shout out to them. So this is so much fun. I mean, we could talk about Wall Street forever. I mean, Avi, how long have you been on Squawk Box?
I've been hosting Squawk for about 15 years. I've been coming on the show probably for 20, and it's been.
And what did you do before that?
So I started as a writer for the New York Times covering business news. I still write it. I run Dealbook at the Times.
Okay.
I do the show on Squawk, and then I wrote a book called Too Big to Fail after the financial crisis. We made a movie out of that, and then we wrote this one. So
is this going to be it's not movie.
It could be.
It could be.
We're hopefully.
You know what? With all that information, the stuff, because nobody knows that story. Even for me, somebody who knows a lot about history, that would be a great movie. You're absolutely right.
I hope you enjoy it.
You know what? I'd love to be in it.
I appreciate it.
It'd be my pleasure. You have been absolutely wonderful.
Thank
I
you.
hope we talk again.
Absolutely.
You know what? Trade like Einstein, Money News Network, Einstein and odds. That's all I got to say about that.